I can't do it. I can't make another one of these fear-mongering videos about how the housing market's going to crash in 2023 when the housing market is finally getting good again. And by good, I mean there's some wiggle room, there's some distress, there's some choppy waves, there's an opportunity for smart buyers to take advantage of what's going on, and that's what this channel is about. It's about sound analysis and actionable strategies for housing market participants. So here's what we're going to do. First, I'm going to explain very briefly why mom and pop investors are not going to crash the housing market in 2023. Then I'm going to look at the headwinds they're actually facing, the distress that this small segment of participants is actually facing. And then we're going to talk about 3 strategies that you can utilize to take advantage of their distress to get a good buy in 2023. So if you're like a forever renter bedwetter and you want to watch some panic porn, go somewhere else. On this channel, we're talking about how to win in this really, really rocky real estate market. Okay, diving right in, this is the article that got everyone all verklempt a month ago. Investor home purchases fell 30% in third quarter, largest drop since Great Recession, aside from pandemic start. And the headline graph that has everyone scared, investor home purchases plummet as housing market slows. And of course, from this, some unscrupulous YouTubers are able to make panic porn videos saying, the sky is falling, the market's gonna crash. And it does look very scary. Back in 2021, investors dove into the market, and we saw this 141% increase in investor purchases, and now we have this 30% decrease year over year of investor purchases. If this isn't a sign of the apocalypse, what is? So first we have to appreciate that this graph shows us that investors are buying fewer homes as home prices are falling. That makes sense. But let's just go a little deeper under the hood and see what this article is actually telling us. Investor purchases fell 30.2% year over year, while regular home purchases fell 27.4% year over year. So fewer investors are buying homes relative to regular home buyers, but both sectors are down about the same amount. Furthermore, if we go down to the bottom of this article and we hear what Redfin actually describes as an investor, we get this. We define an investor as any buyer whose name includes at least one of the following keywords: LLC, Inc., Trust, Corp., Homes. We also define an investor as any buyer whose ownership code on a purchasing deed includes at least one of the following keywords: association, corporate trustee, company, joint venture, corporate trust. This data may include purchases made through family trusts for personal use. So what you have here is a sloppy definition of the word investor and an article that shows that investor sloppily defined purchases dropped a little more than the overall home buyer demographic. In other words, it's kind of a big nothing burger. But moreover, the housing market is just very unlikely to crash in 2023. Let me show you why. This email landed in my inbox this morning. It's from Housing Wire. This is the industry rag. If you want real housing news, you subscribe to Housing Wire. And look at these top 2 headlines in this morning's email. First, housing market tracker, purchase apps jump 25%. Secondly, housing inventory falls under 1 million again as sales collapse. So long story short, demand is low but growing, and inventory is exceptionally low. Is it possible the housing market could crash in 2023? It's possible. I mean, Russia's still invading Ukraine. There's a COVID outbreak in China. Apparently the earth might stop spinning. It's possible that something might cause a housing market crash in 2023, but these are all extremely low probability events. So this right here is the reality that a lot of mom and pop investors are facing. And this is a post from one of my Instagram friends, HouseHack LA, which used to be the name of this channel. And this is an update on a flip that HouseHack LA invested in last year. Let's just read. Ugh, this post is a painful one. My first flip has turned into my biggest loss to date. We partnered with Milk House and the investor on this flip in South LA last year. Michelle and I took a $120,000 HELOC on our house hack and invested it as part of the gap funding for this flip. The HELOC was at 0.09% interest rate for 1 year before turning into an adjustable rate. So we're basically borrowing that $120K for $100 a month in interest for the first year. The flip was supposed to take about 6 months to complete, but ended up taking almost a full year. We turned this craftsman 2-bed, 1-bath into a 3-bed, 3-bath. Our plan got held up with the city and took more than 3 months to get approved, and then we had some other delays getting all the finishes done. The house came out beautiful, but the longer the project dragged on, the more I got tired and frustrated with it. The last 2 months of it were the hardest when it became apparent that we were most likely going to lose money, and the only thing we could do was finish the project. When we bought the house, we originally estimated an ARV at $1,050,000, but the market completely changed and we listed for just under $1 million. It was priced right, and luckily, we got a quick offer at $986,000 and accepted. With all the extra holding costs and lower than expected sale, we took a pretty big loss. I won't say what the total loss was in respect to my partners, but with Michelle and I's portion of equity and paying the HELOC interest, we lost a total of about $15,000 on this project. It really sucks and hurts, but we're taking it in stride. It was our first time trying to flip, and we learned a lot. So we'll chalk it up as the cost of education and keep it pushing. What really hurts is that my partners actually first offered me 10% annualized interest on my investment, but I negotiated for an equity stake. Instead of making $10,000 in interest, we're taking a $15K loss. Now, before you declare that this investor got his comeuppance, he got what he deserves, I just want you to know that House Hack LA is a teacher in Los Angeles, that he and his wife are very much a middle-income family, just using real estate investing to try to make some extra money. So look, stories like this, there will be many of them in 2023. They're not going to crash the housing market, but they do present opportunity for you as a home buyer to take advantage of someone else's distress. So let's talk about 3 strategies that you can utilize in 2023 to take advantage of situations like this. Firstly, number 1, don't be afraid of repairs. So most home buyers are looking for move-in ready homes that don't need any work before they can move in their furniture, relax and unwind. So in a market like the one we're in right now, where days on market is ticking up, but inventory is still extremely low, move-in ready, picture-perfect homes are still going to sell pretty quickly for a pretty penny. What you need to do is look for homes that need a little bit of work, because homes that need a little bit of work aren't going to get as much attention. They're going to sit on the market a little longer, and you're going to be able to pick them up at a bit of a discount. And this is why you shouldn't be afraid of a little bit of work. When you go into a home, I want you to look at the home in toto, in its entirety. The layout of the rooms, the flow of the home. And if you like that, if there are problems, I want you to segregate the problems as tightly as you can. What do I mean by this? Maybe you tour a home and the layout's actually really great and the windows are great, the light is great, but it's just kind of gross. Well, some buyers might just pass on that because it's gross, but actually segregate the problems. What makes it gross? Well, the walls are all smoke stained because the previous owner smoked cigarettes, and the carpets are disgusting. That's actually a gold mine. There's nothing cheaper to fix than paint on the walls. And the second cheapest thing to fix in a home is the carpeting. So a house like that, here's what you do. During escrow, there's usually an inspection period during the first 10 to 17 days of the escrow process. Now, back in 2021, when the market was scorchingly hot, a lot of these inspection periods got waived. They're back. Take advantage of them. So if you see a house that needs a little bit of work, make a list of the discrete, specific, segregated things that need work. Then, during your inspection period, have the appropriate subcontractors come in to give you a quote on how much that work will cost. Have painters come in to give you a quote on how much it would cost to paint the walls. Have a carpeting company come in to give you a quote on how much it would be to replace the carpets. The secret is that most of this work costs less money and takes less time to do than you would imagine. So for a few $1,000s and a delay of a couple of days, you can have the house that has this great layout and great light with new walls and clean carpeting. And when I say a delay of a couple of days, escrow is usually a 30-day process. Let's say your escrow closes on the 15th of the month. What you do is you schedule the painters to come in the 16th and 17th of the month. You schedule the carpet people to come in the 18th and 19th of the month, and then you move in on the 20th. So instead of moving in on the 15th when you close escrow, you move in on the 20th. It costs you a few $1,000s. It delays your move-in a couple of days, and blammo, you've got a wonderful house. And there's a second element to not being afraid of repairs. In this market, sellers are having to negotiate with buyers to keep them in the deal. So if you see a house and it's great, but there's clearly something going on funky with the foundation, or there's clearly something funky with the electrical, put in an offer. During your inspection process, you have your inspector come and take a look, and then if needed, you have further subcontractors come and take a look. So let's say you look at a house and there's clearly something funky going on with the power as it comes into the house. Well, your general inspector is going to note it, and then you have an electrician come and take a look at it and give you a bid for the repair. Then you take that bid straight to the seller and you say, if you want me to continue with this purchase, you need to pay for this repair. Here's another little secret for you. Realtors are required to share all material facts of a home they're trying to sell. What's a material fact? It's anything that could affect the value of the property. So if you get a bid from an electrician who says it's going to cost $4,000 to fix the electrical problem up there, and you give it to the realtor and say, I want your client to pay this $4,000, if the deal falls apart, the realtor is required to share that bid with any subsequent buyers. So your leverage at this moment is fantastic. And one more word about repairs. I see a lot of buyers who say, well, I'll take on minor repairs, but nothing major. You know, like if the foundation has a problem, I don't want to deal with that. The bottom line is, As the buyer, you're not going to do any of this work. All it comes down to is what the work costs to do. And if it's not exorbitantly expensive, you can get the seller to pay for it. So if you see a house that has like a clearly terrible foundation issue with it, don't say, oh, I don't want to get into this. This is going to be expensive. Get into it. Have a foundation company come, give a bid, and then give that bid to the seller. See if the seller will pay for it. If so, you're golden. You've just gotten a brand new house. And if not, you walk. It's that simple. I made a video about a duplex that I bought with a client. We renovated it. It increased the equity of the property by 150 grand. I'm going to link to it up there right now. If you're interested in how renovations can help improve a property, check it out. Tip number 2, investigate renovation loans. So renovation loans are this kind of very cool loan product that allows you to borrow money to purchase a home and renovate it. Here's why reno loans are especially prudent in 2023. In the flip example we looked at today, this guy, these flippers managed to complete the project and then sell it, albeit at a loss to the people who invested equity. Some flippers won't even get to the point of finishing the property before they need to unload it so as to cut their losses. Now, when a flipper is trying to sell a property that they haven't completely finished flipping, they're in a bit of a bind. Traditional banks won't finance homes that aren't finished. So if, a flipper was trying to add a kitchen to the back and the walls aren't finished and the plumbing isn't finished, a bank's not going to loan on that. So a regular home buyer is not going to be able to get a loan to purchase that home. At the same time, with prices having fallen the way they did last year, other flippers aren't going to want to take on the project either. So who can come in to buy this property? A buyer with a reno loan. Why? Because reno loans allow a buyer to buy literally any property in any state of disrepair because the loan is based on what the property will be after it's renovated. So as a buyer with a renovation loan is one of the quills in your arrow thing, I forget the analogy, but if you have a reno loan option in your back pocket, then you'll be able to be a buyer for these properties that otherwise don't have buyers. That means that the seller is going to be very anxious to sell. You're going to be one of the only people who can come in and buy it, and you'll be able to get a great deal. I've made a video about renovation loans. I'm going to link to it right here. Check it out if you're interested. I highly suggest you investigate renovation loans and add it to that arrow analogy. What is it? A quiver in your quill? Whatever the analogy is, put it down in the comments. I will thank you profusely. But anyways, watch the video to learn about reno loans. Strategy number 3 to take advantage of mom and pop distress in 2023. Consider buying a multifamily property. Now, in the internet, this is called house hacking. It's when you buy a multifamily property, you live in one unit, and you rent the other units for income. I'm super big on house hacking. I am a house hacker. A lot of mom and pop investors want to start with a duplex or a triplex or a fourplex. They might run into trouble, and now they need to unload them. So you're probably going to find some pretty good deals in the multifamily territory. Living in a multifamily property feels like a mixed bag. On the one hand, you're getting rental income from the other units, which is great. On the other hand, you need to be a landlord, which can be less than great. So I've made a ton of videos about house hacking. You can check out my channel for more, but I'm going to link to one right there about the downsides. So if you think, I don't know if this is like exactly what I want to do, but you're kind of curious, watch this video first. I go through all the downsides, why it sucks, why it doesn't suck so much, and you'll be all the wiser for checking out this video. Please subscribe to this channel. My name is Jon Schwartz. I'm a house hacker, real estate investor, and realtor in Los Angeles, California. See you next time.